Hello and welcome back to All Things Money. I'm your host, David Blain. During this final segment of today's show, we're going to continue talking about the ebb and flow of investment style. And last segment, I introduced the topic and went into a lot of detail. If you missed it, you'll want to catch up over on our website, which is dlblain.com. We'll post archive copies of the show there in a week or so. But I was talking about Jeremy Grantham, and I'm not going to repeat the whole thing here, but he talked about where 90% of investing brilliance or incompetence is really attributable to the style of investing and what is in and out of favor. And we talked about different styles that have gone in and out of favor the past 10 or 15 years and how it makes people look brilliant or incompetent depending on which style is in favor. And we talked about the globally diversified portfolio. The risk-controlled, globally diversified, multi-asset class portfolio has really been out of favor the past two years or so. And how a lot of investors, after 1 year, 2 years, they become very discouraged and dump, their mutual fund or their portfolio, or in the institutional world, they change managers at exactly the wrong time. There's a study out there, it's called the D.L study, and these guys, every year they go out and they get this big data feed, I guess, of brokerage transactions, and they're able to look at, now not by name, but by account number of investors' accounts, and they can see, kind of what people are buying and selling, and they see that the average holding period for a fund is about 3 years, and it corresponds exactly with the investment styles going in and out of favor. And what they see is that people pile in the certain investment style, and it reaches, its peak, people are piling in. By the same token, they see as investment styles go out of favor, people jumping ship, dumping their mutual fund, and finally at the bottom, everybody's selling. At just the time that one that's hitting the bottom now starts to come back in favor, and the one that was peaking now starts to go out of favor. And they've shown this. So even when the market does return, say, 8 or 9% on average per year, the average mutual fund investor returns somewhere around 3%. It's called the D.L study, if you want to look into it. It's D-A-L-B-A-R. So my point in this part of the show is to say that by acknowledging that investment styles ebb and flow and they go in and out of favor would go a long way towards improving the investor performance of people. And what you want to look for is an advisor like us that has a process in place that is rooted in some sort of principle that of managing money that is proven to be effective over time. So anyway, that's some good advice there. That markets tend to mean revert over time, and what we mean by that is there is some average return. Really, it's an unknowable average. You hear a lot of times quoted, stocks return 9-10% a year. Is that really truly the average? May or may not be. That's been the experience in the U.S. since the 1920s. But investments do have some sort of compensation for risk, and it does vary over time. But the reality is that you can't expect to make 25% a year as we did in the late 90s on U.S. stocks and expect that to continue forever. That things revert to the mean, and as it happens, they usually go well under the mean, meaning that they overcorrect. It's kind of like a pendulum. As it swings too far one way and then it has to swing back the other direction. Well, investment styles are exactly the same way. That emerging markets get ahead of themselves and they have to go back the other way. Gold swings one direction, then it has to go back the other way. And so trying to time these moves of mean reversion is very difficult to do. And overly euphoric or pessimistic markets tend to cloud people's judgments. Their emotions get in the way. And so you have to have a process to counteract that. That these excesses, these bubbles, can last forever. That's the other thing, is when you see a real estate bubble that started in the late or early 2000s. You see a stock market bubble. These bubbles can last for a long time, and so trying to time them is extremely difficult. But when that market bursts, when that bubble bursts, you really need to watch out. because they have a tendency to be very drastic. Now, the markets in free fall, they also act like somewhat like a bungee cord, in that they hit bottom, they tend to really snap back in very severe rebounds. Look at the most recent market decline of March of 2009, the big rebound. So just think of, the fact that markets tend to mean revert over time, and excesses in one direction tend to lead in excesses the opposite direction, and these moves can be quite volatile. So the point is trying to figure all that out and get your timing right. You can certainly, around the edges, we believe in managing the risk, and as asset classes appreciate a lot, there's nothing wrong with cutting back on it, but to try to time 100% in out of the market is almost impossible to do. The other thing that goes along with this is that there are no new errors. That excesses are a permanent fixture. There's a company that called Global Financial Data, globalfinancialdata.com, I think. They have aggregated over the years. They're one of the premier data providers of investment information. They have records of stock going back to the 1600s. And bonds, similarly, bonds have been issued in England, since the mid, 1500s, and they have records going back. They've painstakingly accumulated this vast knowledge of market data over the years. And when you hear this time is different, you really need to be careful, because markets have gone through a lot of changes over the years, but there are certain principles that are time tested, and it is that people overreact to information in both directions, both on the upside as well as the downside. You may have heard of the tulip bulb mania back in Holland in the 1500s. People were paying the equivalent of thousands and thousands of dollars for tulip bulbs, and then it came crashing down. In fact, Isaac Newton got caught up in that. The man that could figure out gravity said that, he didn't understand investing and things like that. So that's a couple things for you to remember. If you missed the first part of this segment or the rest of the show, head on over to the website, dlblain.com. I think it's one that you'll want to listen to again and again, talking about the ebb and flow of investment style and not getting caught up in selling out when an investment style goes out of favor and buying into the latest, hottest investment fad. I think it will serve you well. Just remember that mean reversions happen over time, and that excesses in one direction lead to excesses in the other direction. Well, that's all the time we have. I hope you'll join us again next week.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.